Real estate investment practice problem using OneNote. Multiple loans calculation. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, down in the 6091 Multiple Loans tab. Also note, when using OneNote, take a look at the Immersive Reader. Our presentations, they're also in the text area. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below, scenario being that we want a $500,000 loan, and we have the 3 loan option in order to get there. First loan for the $100,000, second loan for the $200,000, third loan for the $200,000. We want to consider what the cost would be to have basically the 3 loan option, and in so doing, possibly make some comparisons to having different loan structures, multiple loans versus single loans. So the first loan we have, and note that we're going to put the home price up top, but really we're concentrating just on the loan amounts. We're in essence starting down here, the $100,000 loan, 30-year loan, 360 months, 30 times 12. The rate for this one's going to be the 6%. The payment calculation using the standard PMT rate function in Excel, 599.55. The second loan, $200,000. We're going to say this one has a different term to complicate things a little bit here. It's not a 30-year, it's a 20-year. 20 then times 12 would give us payments of $240. The rate's going to be a little bit higher on the second loan at the 6.5% payment calculation based on that information, $1,491.15. Third loan, also $200,000 to get us up to that $500,000 total we're looking for. It also has a different term, which we're going to say is going to be 10 years instead of the 30 or the 20. 10 times 12 then being 120 payments. And then we have the rate increased once again to the 7%. That would give us payments for this one at the $2,322.17. So there's going to be our 3 loan scenarios. We can then construct our amortization tables, and we do this in Excel if you want to take a look at how to do that in Excel. The first loan over here, we had the $100,000. We had the $600 on the payment about rounded. The interest at calculation using the 6%. And that will give us our loan reduction and the loan about. The second loan for the $200,000, this one calculating using the $200,000, the payment $1,491 about, the interest using the 6.5 in order to calculate the interest. And then the third loan, let's scoot on over here so we can see it. The third loan, also $200,000, but the payment here is at the $2,322. Interest calculated using the 7%, and there is our 3 loans. Now this one on the right is going to terminate after 10 years, it being fully amortized after that point in time. The second one over is going to be going out, what we said, 20 or 25 years, was it? 20 years. The third one, it's fully amortized and paid off. The third one going all the way down to our standard 30 years before it is going to be fully paid off. Now, if we think about those 3, now we're going to say, okay, now we got different terms, and we got different payments, and we've got different rates. How would I compare that to some other kind of loan option? One way to think about that is to try to focus everything into the series of payments that you're looking at, and that's one way that you can kind of wrap in the rate to find a rate that would be possibly comparable to other types of loan scenarios that you might consider, like 3 loans at different amounts and different rates and different terms and all that kind of thing. So we could say, let's try to break this into a cash flow type of scenario. The one to the left then being our first scenario. The one to the right we'll talk about later, that being a scenario where we're going to say we're going to stop after 15 years. So on the left, we're going to say, okay, we got a cash flow at least for the first 10 years, which is just simply going to be the sum of the 3 payments. So the 3 payments that we had, pulling out the trusty calculator so we can do calculations. The 3 payments were $599.55 plus $1,491.15 plus $2,322.17. So we've got the outflows for the first portion of until the first loan is gone of the $4,413 about. So we have an inflow of 500,000 from the 3 loans, the 100 plus the 200 plus the 200. We can imagine getting that money and then taking it and paying it to the lender, to the seller of the home for the home. Then we're going to be making payments for the first term until the first loan expires of the $1,413 monthly. That would be our monthly outflow. And then after this one had expired, we're only going to have these two left, which would be the 599.55 plus the 1491.15. So after the 10-year time frame, if we scroll all the way down, we got the same payments all the way down. And then right there it happened after 10 years. We got the 121 payment, which is going to be now only at that 2,091 about, which we calculated here because it only has those two payments and the one loan had then been paid off. So we're going to continue paying, but one of the loans had been paid off after 10 years, 10 times 12, of course, being that 120. Then we'll pay this one off for 20 years. So 20 times 12 would be at 240 payment. Last payment at 240 down here. So last payment down at 240. Then we'd have two loans that were paid off, and now we're only paying the $600 about on that last loan that we still have to pay off, that was going all the way down to the 360 pay periods, all the way down here. Now that looks like a tedious calculation, but again, you could do this in Excel fairly quickly. We do it in Excel, so you can work on that if you so choose, or use that Excel template as a guide to do some of these calculations if you so choose. We can then summarize the cash flow, inflows and outflows, and we can calculate the IRR, the rate at which this series of payments would be zero, and that's going to be our 6.48. So that 6.48 then is a number that might help us or be useful if we had different types of scenarios with different loans, 2 loans versus 3 loans versus shorter loans and longer loans, to try to compare different loan scenarios. This would be a way that we can kind of wrap that information into one number, possibly making easier comparisons. So obviously we would be comparing the payments amount, how much would we pay total. We can think about the cash flow amount that we would be paying total, and then we might want that rate to do that comparison, which takes into consideration time value of money as well. Now, because these have different terms that are taking place here and whatnot, then we're going to have a situation where the IRR could be different if we were planning on holding the property for some time frame other than, say, the 30-year time frame. So, for example, if we were going to hold it for 15 years, even though we got these 3 loans, 30, 20, and 10, then we might see it something like this. Same cash flow. We got the inflow of the 500,000 we used to pay for the home, the outflows of the 413 for the 10 years after 120 payments, bringing us down to here. That first loan's paid off. Now we got the 2 other loans, and then we're going to go down to 15 years, stopping at payment 180, because 15 times 12 would be 180. So we're halfway through the 30 year. And then that last payment, we'd have 2 loans that had not yet been paid off, and we have to think about what the loan balances would be if we were to sell the home and pay off the loan balances at that point, given the cash flows that would be outflows at that point. We could pull that from the amortization table at period 180 after 15 years. So it would be right here. So right there. So like this one. So it would be this one, which would be 7171,049, and plus this one over here after the 15 year, 76211. That's going to be the 147,260 plus the last payments that we had to make, which was 600, plus this payment of about 1491. That would be our outflow at the end if we had to pay off those 2 loans. The third loan had been paid off, so it's done at that point, and that's where we're getting the 249,350. Then we could total up the cash flow, and that would give us the 6.51 at the rate. So the 6.51 after the 15, which is it's 6.48, pretty close for the 30. So again, that's one technique that you can kind of use if you're looking at different loan scenarios. It can be useful oftentimes to try to roll everything into a rate. And if it gets complex, it could be difficult to use a rate function to do that. And even if you can, sometimes it's easier to try to break this thing out into a cash flow. And then your goal is to basically value the cash flow, right? What would be the kind of the present value of the cash flow? You could pick up the rate then on the cash flow, the rate at which the cash flow would then be zero. That giving you that kind of percent, similar to like an average. If you're trying to make an average for someone's job performance, like someone who's a baseball player, you're trying to figure out that percent that can compare possibly one to another, even though they have different at-bats, how often they get on base, and so on and so forth. So that would be, that is that.